I've seen a lot of people refer to you / accuse you of being a buy at any price investor. Do you think that you are in fact a buy at any price, or do you think there's any sort of semblance of reality in that? And B, do you think people tend to relish when things don't work out for you, they tend to relish it more than they do for any other fund manager?
So you'll have to ask others whether they relish. I can only answer the question from our perspective. So let's look at the flagship product. Right? I'll go through a few of our funds' performance so that we can deal with this question rationally rather than through my invective. So the flagship product CCP is now 5.5 years old. Net of fees is generated roughly 16.5%, right, over the 5.5 years. Earnings growth for the underlying stocks, turnover is pretty low in CCP, right? So it's a 17 stock portfolio. We barely buy 1 or 2 stocks a year. So it's a pretty stable portfolio. Turnover is around 15%, which means a typical company stays in the portfolio for 6 years or so. So it's a pretty stable portfolio. 5.5 years of doing it in Marcellus. Returns are around the 16% mark net of fees. If you take it gross of fees, returns will be around the 18% mark. If you look at underlying earnings growth for those companies, they've been around 18-19%, right? So over that 5.5 year period, P's went from roughly 37, 38 in December 2018 when we started the firm. They went all the way up to 55 times in Jan 22. Then from Jan 22 to March 23, the PEs fell because the portfolio corrected sharply. And roughly today, the PE stands where it was 5 years ago. So PE went up, PE went down, and therefore the main driver of compounding in CCP was earnings growth. Earnings growth was around 18%, knock off the fees, and you get to around 16% client level compounding on that. If you now come to our global compounders portfolio, which we started the best part of, I think, now 20 months ago. That's compounded at net of fees, that's compounded at the 31-32% mark. Their PE growth has been, both rupee and dollar has been same because the currency thankfully stayed stable. So I'm talking in rupee terms. EPS growth in that portfolio has been around 24-25%. There's been a little bit of a PE improvement because when we started in October 22 to now, PEs of those portfolios of those stocks have gone up a little bit. So global compounders, out of the 32% that we're generating, the vast majority is coming from EPS growth and a little bit of PE re-rating, right? If you look at our Meritor Q, our quant PMS, their compounding has been in the last it is around 19 months old. Compounding has been around the 20% mark. Same maths again. Earnings compounding 20, EPS compounding, earnings compounding 20, and share price compounding around 20. Right. So these three portfolios have done well. Now let's come to the portfolios which haven't done well. Little Champs had a great run from birth in August 19 till September 22. Right. EPS compounding was 25%, portfolio compounded at 32%. PEs rose. PEs rose from birth in August 19. For the first 3 years, PEs rose. From September 22 to now, Little Champs has not made any money. It's underperformed underperformed both BSE 500 and BSE small cap. But the PEs haven't come off. What's happened to Little Champs is profit growth has disappeared. Right? So our failure with Little Champs over the last 1.5 years has been that over 5-6 quarters, profits have not grown at all, and the portfolio therefore has tanked. PEs, ironically, for Little Champs are where they were 1.5 years ago. Right? So the point I'm driving at is, it doesn't take a huge amount of research to figure out at what value should you completely avoid a stock. Right? What it takes a lot of courage to do is look at a PE and realize that this looks optically high, and if you do the underlying work on this, it's actually not that expensive, right? And that takes a lot of courage to do, because you know that if you buy that stock and it comes off on you, then clients will be disappointed and your critics will be happy, right? So a classic example of this was our entry into Trent in August last year, right? So we researched it with met management over several years, and our bugbear had been that beyond West Side, they were not making money in their other beyond West Side and Zara, they were not making money in their other retail offerings. But by August last year, we realized that Zudio was a very powerful offering in the mass market, and we built that position. And we spent a lot of time deliberating this whole PE multiple business, right? Because even by August last year, West Side was 70, 80 on PE. But when we did the math and we unpeeled the onions on our EPS forecasts, which were significantly ahead of consensus, on our EPS forecasts, the PE was coming out to be around the 40, 45 mark, not the 70, 80 mark, right? So we bought West Side in August last year. Between August and November last year, the stock went up, I think, around 30, 40%, right? In November, we doubled the position after the stock having risen, right? And again, the same discussion ensued. Are we being foolish, suicidal in buying stocks with high PEs? And again, the research suggested that our EPS estimates, our forward-looking EPS estimates, are rising even faster than consensus is. Consensus, I still don't think, has fully understood what the West Side team is doing or the Trent team is doing. And hence, we doubled the position in Trent in November last year when the PE was optically at least north of 100. Now, the position is doubled on us in 7-8 months. We have to think about what we do with that position now. But the point I'm driving at is, you will typically make money in investing when you make calls which to other people look suicidal. This is similar to, say, our trebling our Bajaj Finance position in May 2020, when the stock was down 65% in 4 months. We trebled the Bajaj Finance position. You could argue the PE was infinite then, because it was not even obvious that in the year ending March 21, Bajaj Finance was going to make a heck of a lot of money, if anything at all, right? So you'll typically make money in investing when you do things which appear to other people to be super tough to the point of being crazy. And your job as an investor is to do the underlying work, do the maths and figure out whether the odds are in your favor. If they are in your favor, you go ahead and do it. If you get it wrong, then you tell the whole world we've got it wrong. And if other people get some joy out of having a go at you, then good for them.